Hi everybody, this video will give a quick overview of the new dividend withholding tax in South Africa, how it differs from the old secondary tax on companies, and how the new dividend withholding tax will affect the average Joe's pocket. From now on I will be abbreviating secondary tax on companies to STC and dividend withholding tax to DWT. The reason for replacing STC with DWT is that DWT is the commonly used international system of taxing distributions by companies and is a system that foreign investors are familiar with and understand. Therefore, the replacement of STC with DWT was to align the taxation of distributions by South African companies with international practice. How DWT works in a nutshell is that 15% of distributions made by a South African company will be withheld and paid over to s.a.r.s. The following two examples will illustrate how much Mr. Average Joe will receive into his bank account at the end of the day under STC and DWT. In both examples, the company will have 110 Rand available to pay to its shareholders. Now, what this means for Average Joe under STC is that he would receive 100 Rand. So the 110 Rand the company had available is paid out as 100 Rand to the shareholder and 10%, 10 Rand, as STC. Under DWT, Mr. Average Joe will only receive, as you can see from the calculation, 93 Rand 50. So that's the 110 Rand less the 15% withheld and paid over to s.a.r.s. Under the 15% dividend withholding tax, Mr. Average Joe is receiving 6.5% less than what he would have received under STC. Mr. Average Joe is in a worse off position and is indeed not very happy about his situation. Certain exemptions to dividend withholding tax applies in terms of Section 64F of the Income Tax Act. Note, however, that Mr. Average Joe will most probably not fall into any of these categories. Thanks for watching and happy investing.